Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm here to help you maximize your cash flow. Now, one of the ways that we do that is by practicing infinite banking. And with infinite banking, we use some type of product, some type of financial vehicle in order to become our own bank. And you could do this with a number of different products out there. But the best that we've found in order to get the most guarantees and in order to have the safety and liquidity necessary to do this, we utilize high cash value whole life insurance policies. And we do that through mutual companies that have a history of paying dividends for over 100 and 150 years. Now there's probably about 1,000 insurance companies out there. Not all of them offer products that can even be designed to properly use for infinite banking. And then there's another small few that have products that we can optimally design to utilize infinite banking. And even within that small world, there's going to be different products that are going to fit different needs. So today I wanted to talk to you about Guardian in particular. I try to ally myself and contract with the top companies out there that have the best products that can meet your needs, regardless of what those needs may be within the infinite banking world. Guardian is one of those top companies, and I happen to write most of my policies through Guardian. Probably 90+% go through Guardian. And it's for a number of reasons that I want to go over with you today as to why Guardian works so well for the infinite banking concept.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So there's a few key aspects that make Guardian one of, if not the top carrier for you to practice infinite banking with. Now those things are safety, flexibility, liquidity, design, and history. First, let's do safety. Guardian is a direct recognition company. Now in the infinite banking world, there's a lot of people that love to pitch the idea of non-direct recognition and how they feel it's superior. Direct recognition and non-direct recognition have to do with what the insurance companies do when you take a loan out against your policy. Do they recognize the loan? That would be direct recognition. Or do they ignore the loan? That would be non-direct recognition. Now, if they're ignoring the loan, that means that you're going to get whatever the dividend rate is, regardless if you have a loan or not. And you will either be set with a fixed or a variable interest rate. Oftentimes, in a non-direct recognition company, that fixed interest rate, if you have that option, is going to be fairly high, maybe around 8%. If you have a variable rate loan, it may be lower, 5% or so, but it's variable. So you don't have the safety of knowing what that interest rate will be long-term. So if you're practicing infinite banking and you're having loans out, long-term loans out for any reason, that presents more of a risk than a direct recognition company. Now the direct recognition company, Guardian in particular, recognizes that you take a loan out. And what they do is they will credit you the same amount in your policy for what you borrowed. They will credit you the same amount as what you're paying for your loan. So in this instance, Guardian typically has a fixed rate at 6% that you're borrowing from, but then they'll also credit you 6% on the amount of cash value in your policy that you're borrowing against. In today's interest rate environment and the dividend rate environment we're seeing, that's a pretty good deal. What we have right now is dividend rates that are just under 6%. So if you're borrowing against your policy, you're going to get credited with a higher rate than the dividend would have paid you. Pretty good deal, But the main reason we like this for doing infinite banking is because of the safety of knowing long-term what is happening with these interest rates. You have a guaranteed fixed rate, you have a guaranteed credit rate. Those are contractual, they will not change. So that provides a certain level of safety, which allows you to put more of your income into the policy and not have risk associated with it. So when we look at creating wealth building blocks, and you can check out that video right here on wealth building blocks, but wealth building blocks are ideas on how we can change regular expenses and divert them through our life insurance policy in order to increase the amount of money that we put into the policy each year, knowing that with our infinite banking process, it's going to compound for us for the rest of our lives. I prefer to do that in a policy that has the most guarantees that we can possibly get. That comes from the direct recognition company, in my opinion, and I think a lot of my clients tend to agree with that, which is why that's most of the policies that I write are with Guardian. So that covers the safety aspect, but there's more. Number two, we have the flexibility of Guardian. The flexibility that Guardian offers with the way that we design these policies, it ends up being a cornerstone of how we practice infinite banking and how much of our income we can actually flow through the policy. So because we can design these policies with a 10-to-1 paid up additions compared to the base premium, that means if you were to do a policy with an annual premium of $20,000, we could design it where the base premium, the amount that you're expected to put into the policy each year, is only 10 times less than that, so $2,000. Meanwhile, while practicing infinite banking and dynamic banking and going through your life throughout the year, you can dump in all the rest of that $20,000 at any point throughout the year. You're not obligated to make that $20,000 payment if for some reason you can't do it, okay? Or if you need that time throughout the year in order to come up with all of that premium, you have the ability to do so. Or if you're in a job or if you're in a position where you get a lot of your income all at once, this can really help out. So real estate agents, real estate investors, anybody who earns commissions, you may end up with some months that are very big and you can contribute more to the policy, and some months that aren't, where you want to cut back and not contribute to the policy. Guardian offers that flexibility. In comparison, another one of the major companies that I write, Mass Mutual, they do not offer that same type of flexibility. They want to know when you sign up the policy, how much are you going to contribute on your expected due date, whether that's monthly, semi-annually, quarterly, or annually. They want to know exactly how much you're going to put in. So we have to include all of those paid up additions that we're expecting to put in, and we're going to break those out in set periods throughout the year, or do it all at once at the beginning of the year. It's a little bit harder to do that if you're talking about large amounts of money. So I personally have a policy with Guardian and I have a policy with Mass Mutual. And my policy with Mass Mutual is much lower because I'm not comfortable being on the hook for putting on a huge amount at a certain point in the year on any given year, because I may have those funds out and working for me somewhere else. I may not have that much available. So while I'll have a $50,000 annual premium with Guardian that I know I can put in any point throughout the year, I'm only going to have a $13,000 annual premium with Mass Mutual, because I know that when that anniversary period rolls around, I'm going to be able to come up with that much. Now, that doesn't mean you can't put in different amounts with Mass Mutual. It's just that sometimes you may have to prove through underwriting that you're actually not doing it because you have had some type of health event that puts them on the hook. So their main concern is, why are you wanting to put in extra money into your policy? Is it because you suddenly found out you're sick and you're just trying to take advantage of us as a company? They're going to make you go through underwriting for that. So I end up with a much smaller annual premium with Mass Mutual than I do with Guardian because of that flexibility. Now, Along with that flexibility too, we have the ability to catch up. So if we end up putting in less than the max, say in year 2, we can catch up and put in extra in year 3 so that we're still up to our MEC limit in years 1, 2, and 3, which is our goal. You want to get as close to the MEC limit as possible in order to maximize the use of these policies. Reason number 3 we like Guardian is liquidity. Guardian offers the ability to get your money in and out of your policy very quickly, often in as little as 2 or 3 days, using electronic funds transfers through your bank. We can do this if we have you set up on monthly payments, where Guardian will keep your bank account information on file. You can go right into the app on your phone and you can transfer money back and forth. You can pay your loan off and you can borrow against it just by going through the app. No need to contact your agent. No need to wait for a check in the mail. This provides a level of liquidity, which I think is key when we're thinking of putting in the types of money that we're talking about into these policies, when we're talking about using them for emergency funds to store a large bulk of your emergency fund. You want to have access to those funds within a week, okay? 2 or 3 days is ideal, but a week is probably as long as I would like to wait. It can't really address much of an emergency need if it takes longer than that. So having that liquidity in the policy is very important. Now, along with that liquidity is how much of your cash is available in year 1, how soon do you break even? Those are important things. And with Guardian, we can get you close to 90% that's available in year 1 because of the type of design we do, where we do a 10-to-1 paid up additions. Having access to 90% of your cash value in year 1 makes it a lot easier to put money in. So all of the money that we're putting into paid up additions turns into basically cash. And when we're doing a 10-to-1 paid up additions to base premium, that means almost all of the money that we're putting in is going to be available in cash value. Now, our break-even periods, we can usually get those between 3 and 7 years. Mostly 4 years seems to be kind of the magic number with these designs. But if you're doing a 1035 exchange, that can help shorten that time period. If for some reason you have a reduced health rating, that could extend the break-even period. But we can still, regardless of your health rating, we can still typically get you to a break-even within 7 years, depending on which product you end up going with. So for our real estate investor friends who don't like to tie up their money for long periods of time, but you want to take advantage of what these types of products have to offer, Guardian is an ideal company because you do have access right away. Now, Guardian's not the only company that gives you that type of access, but when you lump it all in together, that's why people really like this product. So reason number 4 is design. Now, this kind of goes along with the liquidity and the flexibility, but being able to design these policies with a 10-to-1 paid up additions to base premium really makes a big difference when it comes to being able to access your cash value early and grow in cash value, because what we're doing is we're really minimizing the insurance costs of these policies, which minimizes the commissions paid to agents, and it minimizes all of the charges that are going to go out to the insurance company starting in year 1. Keep an eye out for my next video, which I will go over specific designs on the L95 and the L99 of the Guardian series products. Because even within this world of Guardian products, your needs are going to dictate which product is going to work best for you long term. And so we look at designing these in order to fit your needs. And you've got to have some flexibility in that design in order to best match whatever the client's financial needs are going to be. Not a lot of companies out there allow these types of designs. Some of them, you end up with a 4-to-1, or you might see 40 to 60% ratio or 30 to 70% ratio. there's a wide range of what people can do for designing base premium compared to paid up additions. And that's going to directly affect how much cash value you have in year one and how much cash value you have the ability to grow throughout the life of that policy. And it's not even just what happens within that policy that design is important, because we're not doing infinite banking just to do infinite banking and to rely on the returns that we're going to see from any of these insurance companies. We're using infinite banking in order to maximize the use of our cash flow. We're using it for investing in other assets, for elevating our investing in the whole rest of our lives, right? If you know that you're going to have a 4 to 6% return with every dollar you put into your infinite banking policy, you get to be more picky about what you're going to invest in outside of that. You're not going to take your money outside of that and use it for a risky opportunity to earn 6 or 7%. It's just not worth it. Why would you go through that risk? So it allows you to make better decisions on where you're going to put your money and what type of other asset risks you're willing to take in order to earn extra interest. So this is truly the and asset, and we need to consider that when we think about how that design is going to work. How long is your money going to be tied up in these policies because of the insurance costs that are on the back end of it? And our goal with design is to minimize that as much as possible. And reason number 5, we have the history. Guardian has a 150 plus year history of dividend paying results. It goes through every recession, through the Great Depression. They've never not paid a dividend. And if you look at the historical value of it, they're in the top. MassMutual and Guardian are the top 2 for dividend payouts historically, even within the last 20, 25 years. We don't want to just consider dividend rates when we're trying to decide between one company or another, because the reality is dividend rates fluctuate. Regardless of which company you're looking at, they go up, they go down. But if it's a well-run company that you want to be an owner of, this is why we look at these mutual companies, because those dividends are what helps you accumulate and constantly get that compounding growth for the rest of your life. So you want to make sure that you're becoming a part owner of a company that you actually believe in, one with a long-term history, one that takes care of its clients, and one that continues to pay out dividends and do that at a higher level. Now, it's hard to go wrong when you have a 150 plus year history in that. So those are the 5 reasons why most of the policies that I end up writing end up going through Guardian. It just has the greatest safety, flexibility, liquidity, design, and history behind this company. And I really like what they offer. And I know my clients are happy with the results there as well. So if you're interested in exploring more of what Guardian has to offer, feel free to sign up on my Calendly link. It's calendly.com/cashflow pro. And I'm happy to talk with you about how it can fit in your financial picture. And we can talk about other things as well. I offer 20 minutes of free consultation to anyone on any subject. Just go to my Calendly link and sign up. Now, if you found value in today's video, be sure to hit the like button and subscribe to the channel if you want to continue along on this financial journey together. Thanks for watching. We'll see you next time. Now, go maximize your cash flow.